business ultimately succeeds or fails depends, of course, on a variety of factors. Nevertheless, to thrive and prosper, any business has to consider the rapidly changing business environment nowadays we are dealing with. In this regard, most companies wait for the change to react to it, but the more successful ones prepare for it in advance and thereby welcome the change and even take advantage of it. In short, they are proactive as opposed to reactive. The very first prerequisite for being proactive is to monitor and forecast the related variables, namely political, social, economical, and technological trends, otherwise known as pests. Specifically, we have to anticipate the relevant prices, demands, and supplies within a certain foreseeable future. Besides, we need to make these predictions incessantly in order to be ready for what may happen and in turn take preemptive actions if required. An important application of the forecasts arises when we try to find and capture the most promising opportunities outside our corporation. That is diversification, which can be either horizontal or vertical depending on the kind of products we are expanding our business towards. Needless to say, to perform this on a regular basis, we have to define organizational processes. The stage gate is one such process. On the other hand, intensification refers to detecting and focusing on the most profitable activities being performed inside a firm. This entails some financial analysis, including somewhat cost accounting, data investigation. Noticeably, our decisions are effective in the future, not in the past. Therefore, we better utilize the expected costs and prices instead of the recorded ones. We will elaborate on this issue later. Through this financial analysis, we might as well find some activities that cost more than the value they create. Even though they are not profitable for us, they may stand lucrative for another corporation who has a kind of competitive advantage over us, such as a better location. Hence, we would outsource such unfit activities to whoever is willing to take. Here again, we prefer to utilize the expected costs and prices rather than their historical amounts. Why? The traditional financial accounting system relies on the bookkeeping data for nearly every purpose. I would concur with this assertion insofar as it relates to performance measurement issues, but when it comes to making plans and decisions for future, I would strongly disagree, as it overlooks the potential usage of new information, let alone varying market prices. Actually, the past expenditures are irrelevant to our current decisions or the upcoming ones, unless we intend to take a retroactive decision. Do we? In sharp contrast to this prevailing record-based notion, the proactive system is based on the expected values instead of the recorded ones. It is in fact inattentive to the recorded data, except for estimating the expected levels. So one might as well call it memoryless accounting. To convey this idea, I begin with introducing an elementary example. The first stage of the manufacturing process turns the raw material into our first middle product, work in process 1. This stage costs C1, including all the opportunity costs. Nonetheless, this middle product is worth P1, and evidently this stage is profitable. The next process transforms work in process 1 into work in process 2, and its expected cost is C2. Thus, the total expected cost of WIP2 is P1 plus C2. You see, it doesn't matter how costly the previous stages have been. The only values that matter are those of the inputs to and the outputs from the process. Clearly, the total cost of manufacturing work in process 2 outweighs its market price P2, and thus we should try to get rid of this stage or eliminate it. How? We may outsource it, or we could sell WIP1 and perhaps buy WIP2 for the next stage in case it turns out profitable. Beware, this is not a non-value added activity. This creates an amount of value which does not cover its expenses. The elimination is not a proactive decision, however significant they might sound. Finally, the last stage turns WIP2 into the final product, costing C3, thereby leaving a positive net yield for us. Accordingly, we may keep this activity. So far, so good. In our simple example, there was only one input to each stage. But what if there were several inputs? As you might have already inferred, a simple formula like this one may suffice. To produce any item, there is a process of which the item is the output and its constituents are the inputs. You know, VIs represent the values of the inputs and UIs stand for the amounts of inputs required to produce 1 unit of output. The process may also include other manufacturing costs. However, ideally all costs should be expressed in terms of inputs to the process, even energy, machine hour, man hour, and any other resource that producing the item requires. While being simple, it paves the way for the more sophisticated formulations I'm gonna explain. The formulas I'm about to describe are supposed to value just about anything: a product, a work in process, raw materials, a patent, a machine, a land, a project, or even an idea. Surprisingly, according to this approach, the value of an item is contingent on whether or not we possess the item. In case we have got the item, its value will be the maximum level between the likely benefits from the best usage of it and the expected gain from selling it. In case we do not have the item, its value will be the minimum level on the prospective value it can create, the expected cost of buying it, and the expected cost of making it. That's indeed due to the fact that only the best options matter. Now, to elucidate the logic behind the formulas, let's see how to apply them in practice. Our relationship with our counterpart companies can vary from a one-shot transaction to an everlasting cooperation like vertical integration, depending on the benefits to both sides, namely facilitators and drivers.